Hello future chartered. Welcome to paper discussion series by More Academy. In the previous video, we have made an analysis of December 2021 question paper of accounting. We have identified which questions based on the theory or practical. We have analyzed marks weightage, topics covered, and also what is asked, that is journal, ledger, calculation, etc. In this video, I am going to discuss the suggested answers for the first question. As promised, I am making a playlist of entire question paper with one video per question. Subscribe to this channel so that you will get notification for each new video that I'll be adding for your reference. So let us now start with the first question, which contains 6 sub-questions. Each carry 2 marks. You are expected to state whether each of the given sentence is true or false, and then you are expected to state the reason for why do you think so. So let us start. Now this is question number 1. State with reasons whether the following statements are true or false. You can see here there are 6 sub questions. There is no internal option. So if you choose to solve only 3 of them, then you will be getting maximum 6 marks. To get all the 12 marks, it is necessary for you to solve all the 6 questions. The next point to be kept in mind is that don't forget to write true or false in clear terms at the beginning of your answer. If possible, don't forget to underline the same, and thereafter on the next line or maybe on the same line, start giving your reason. This is how you are supposed to solve the question. Okay, so let me consider one by one each and every question and the solution for the same. The first question is, any amount spent to minimize the working expenses is a revenue expenditure. The point which I would like you to focus on is amount is spent and should it be treated as revenue expenditure or not. So when you are spending the amount, it can be either capital expenditure or it can be revenue expenditure. Let us try to identify the purpose of the same. They have told that the purpose of this spending is minimizing the working expenses. So maybe you are interested in saving your printing and stationery. So you are going to go for maybe having a Xerox machine in your own office. Maybe you want to spend less on your tea and coffee, which is to be distributed to employees, etc. For that purpose, instead of paying to the tea vendor, you are going to have a tea vending machine straight away in your office. So here what is happening? You are interested in reducing your day-to-day expenses for printing and stationery, for maybe tea and breakfast, etc. And for that purpose, what you are doing, you are spending some money. That money is spent obviously for reducing the expenses of working nature. But the spending itself is not of revenue expenditure nature. The spending is of capital nature. That means the given sentence is not true. Given sentence is false. So the answer will be false. It may be reasonably presumed that the money spent for reducing revenue expenditure would have generated long-term benefits. We are taking a Xerox machine, so it will be used by us for a longer duration of time. We are taking a coffee vending machine, tea vending machine, it is going to be used by us for a long duration of time. Maybe we are purchasing a water purifier, so we may not have to purchase bottled water in the office for the purpose of employees. So purchasing a water purifier, purchasing a Xerox machine, purchasing a coffee vending machine are very good examples of long-term benefits which the entity is enjoying, which is going to reduce its working expenses. But this expenditure on water purifier, on coffee vending machine, or on the Xerox machine, etc., obviously is of capital nature. That means this part of the sentence is not true, it is false. So the answer is false. It is better to consider that it is capital expenditure. Let's go to the next question. Expenses incurred on repairs for the first time on purchase of an old building are capital expenditure. Now the first thing which students will notice is that, sir, this is basically repair expenditure. Since it is repairs expenditure, that means it should be of revenue nature. However, it should be noted that the problem is telling you to look at the repairs which are incurred for the first time. Again, the first question which comes to mind, that whether it is first time or it is second time or it is 10th time. Since it is repairs expenditure, that means it should be revenue. But then comes the most important part of the question, that these are the repairs which are incurred for the first time on purchase of which building? Of an old building. So probably your business has purchased an old building, and then before you start using it, you need to renovate the same, you need to repair it, you need to bring it into working conditions suitable for your office, suitable for your factory. So you are incurring the first time repairs expenditure. Now since the expenditure is on an old building, then despite of the fact that it is repairs, we will have to consider it as capital expenditure. Afterwards, once you have started using the building and thereafter you are again incurring the expenses, maybe after 3 years, maybe after 5 years, just for the sake of maintaining it properly, that will be considered as repairs and maintenance revenue expenditure. This is for the first time on an old building. That's why the repairs will be considered as capital expenditure. So the answer is true. Repairs for the first time of an old building are incurred to put the building in usable condition. This is the part of cost of building. Accordingly, this is the expenditure of capital nature. Sentence says provision for bad debts is debited to sundry debtors account. Provision for bad debts is debited to sundry debtors account. We will have to be very careful about provisions. The simple rule to be kept in mind for all provisions that any provision or any reserve, when it is created, it is always created out of profit and loss account. So whenever you are creating a provision, the entry is always P&L account debit to provision for something. It can be provision for bad and doubtful debts. It can be provision for some expenses. It can be anything. But all provisions are always created out of profit and loss account. Therefore, the sentence which states that provision for bad and doubtful debts is debited to debtors account is totally wrong. It is debited always to the profit and loss account. So the answer is false. The provision for bad debts is debited to profit and loss account. The second effect of the same will be in the balance sheet. It can be either as a deduction from debtors or it can be shown on the liability side. But generally it is shown always as a deduction from debtors. On the liability side, it is generally not shown. Anyway, the second effect is not asked by the problem. The problem has asked us only the debit effect, and debit effect is always to the P&L account. So the given sentence is false. It is debited to the P&L account, not to the debtors account. Okay. I hope it is clear to all of you. I'm repeating for the last time. All provisions are always created by debiting to the profit and loss account and not by debiting to any other account. So provision for bad and doubtful debt is debited to always P&L, not to debtors. Non-participating preference shareholders enjoy voting rights. In relation to preference shares, earlier there used to be 6 different categories: cumulative, non-cumulative, participating, non-participating, and redeemable, irredeemable. Under the new Companies Act, a company cannot issue irredeemable preference shares. So now there are only 4 categories: cumulative, non-cumulative, and participating, non-participating. When you are thinking of participating preference shares, you are basically talking about the preference shares who are having, number one, the fixed rate of dividend, plus after making their payment of dividend, after paying the equity dividend, they may be getting an additional chance to share the remaining profit of the company along with the equity shareholders. Similarly, at the time of winding up, after making payment of their capital, after making payment of equity capital, if the company enjoys some extra surplus of assets, that means all liabilities are paid off, entire preference capital is paid off, entire equity capital is paid off, still there are some assets remaining, then this surplus will be distributed among the equity as well as preference shareholders. If that is the arrangement, then such preference shareholders are called as participating preference shareholders. So I am repeating again, preference shareholders can be called as participating if over and above their fixed rate of dividend, they are entitled to get additional dividend out of the profits remaining after making payment of equity dividend. Similarly, if they are going to enjoy some share in the surplus at the time of winding up of the company, then they will be called as participating preference shareholders. Participating preference shareholders always will be getting voting rights. When it comes to non-participating preference shareholders, they do not enjoy both these benefits. Neither they get anything extra over and above the fixed rate of dividend, nor they get any share in the surplus profits of the company at the time of winding up after making payment of equity shareholders. So in short, non-participating preference shareholders enjoying voting rights is impossible. So the answer is false. A share on which only a fixed rate of dividend is paid every year without any accompanying additional rights in the form of profits or in the surplus on winding up is called as non-participating preference shares. Non-participating preference shareholders do not enjoy voting rights. So the sentence is false. There is no entry passed by the consignee in his books for the remaining stock of goods lying with him. Now remember, consignment is a special arrangement where the business is considered as the principal and the consignee is considered as an agent. That means the business will be always considered as the owner of the goods and consignee is never considered as owner of the goods. Even when the goods are sent on consignment, we are not considering it that the ownership is transferred to the consignee or to the agent. We are considering that the ownership rests with us. Only the location, possession of the goods is with the consignee. Although he is holding them, still he is not the owner. These goods, if they are going to remain unsold at the consignee's place, then it will not be shown as a closing stock of the consignee, but they will be shown as the closing stock of the business on the trading account credit side and balance sheet asset side under the heading goods with consignee or goods on consignment. That means this is nothing but our own stock. This is not the stock of consignee. This is not the stock of agent. He is not the owner. He is just holding them. It means he cannot show them as his own closing stock. In other words, he cannot pass the entry for the goods which are lying at the end of the year at his depot, but which is owned by the principal, which is owned by the business. So the given sentence is true. It is the consignor who has to record the closing stock of the consigned goods since he is the owner of the goods. There is no entry passed in the books of the consignee. I hope it is clear to all of you. Consignee is an agent and consignor or the business is the principal who owns the goods. And now comes the last question. Discount column of the cash book is never balanced. Now, this is a very important point. Many times what we specify that it is a triple column cash book. That means debit side there is a cash, bank and discount column. Credit side there is cash, bank and discount column. Cash column will be balanced. Bank column will be balanced. So automatically in the exam circumstances, there is a chance that out of hurry, you may specify that yes, discount column is also required to be balanced. But please remember that although the name is 3-column cash book, it does not mean there are only actually 3 columns. In reality, there are 4 columns. The debit side is cash, bank and discount allowed, and credit side is cash, bank and discount received. So debit side discount column represents discount allowed, which is a different account, expenditure account, loss account. On the other hand, credit side discount column represents discount received, which is an income account, revenue account, gain account. So these two accounts are totally independent accounts. That means there is no question of balancing them. Those two accounts will be totaled and their total will be transferred to the P&L account separately. The debit side discount allowed column will be transferred to P&L account debit side under the heading to discount allowed, and the credit side discount received column will be transferred to P&L account credit side under the heading by discount received. It means the given sentence is true. The discount column is totaled and transferred to the discount allowed or discount received account, but it is never balanced. To balance means take the same total and then finding out what is the balancing figure, which is never done. Totals are kept as they are and they are directly transferred to the P&L account. So the given sentence is true. I hope you have understood now all the 6 questions of question number 1. In the second part on the next video, I'll be talking about question 1, sub question B. Okay, so see you in the next video. Thanks for being with me and let us continue with our studies.